Right now, your retirement portfolio is being revalued in real time. And what truly bothers me is that the largest institutions in the world have been informing their private clients exactly about what is unfolding. JP Morgan and other major banks are sending out international market intelligence macro notes, crisis updates, commodity alerts, everything. Their wealthy clients receive the data. Their institutional clients receive the context. Their hedge fund clients receive the strategy. Meanwhile, ordinary retail investors are left with sensational headlines, panic, confusion, and a crowd on social media pretending that everything is still normal. People need to understand what is truly happening here, because this is not one of those stories you can ignore and hope it simply goes away. The reason this matters so much is that what is happening around the Strait of Hormuz is not some distant geopolitical contest that only affects oil traders and defense analysts. It is a direct threat to energy prices, inflation, interest rates, commodities, supply chains, consumer spending, and therefore it touches stocks, ETFs, pensions, retirement accounts, and your cost of living. If you invest in anything tied to the global economy, which most people do, then this will affect you. The question is not whether it will affect your portfolio. The question is whether you understand it early enough to respond with intelligence instead of emotion. And if you want the full playbook to understand how these shifts unfold, how to position early, and how to invest like a top-tier investor, you can strengthen your skills inside my private group linked in the pinned comment below. You will find the exact stocks I am buying and the plan to become a millionaire there. Now let me lay out the core issue. According to intelligence now, circulating vessel traffic through the Strait of Hormuz has fallen to a level that is close to paralysis. And in practical terms, that means one of the most critical energy choke points in the world is being disrupted at precisely the moment the global system can least afford it. Roughly 1/5 of the world oil consumption and roughly 1/3 of the oil transported by sea normally passes through this corridor. That is not some minor shipping lane. It is an artery. And when an artery becomes clogged, the problem is not simply local. The problem becomes systemic. This is how commodity chaos begins. This is how forced shutdowns begin. This is how inflation can flare up again. Just as central banks were hoping they had finally brought it under control. You can easily watch the traffic for yourself. Look at the shipping activity, and what do you see? Congestion, bottlenecks, hesitation, vessels waiting, cargo building up on both sides. And the critical point here is that the ships you would normally expect to move steadily through that corridor, particularly oil tankers, are no longer moving with their usual confidence. No one wants to send an oil tanker into a region where risk has suddenly surged. Insurance is being repriced, routes are delayed, decisions are postponed, and every hour of hesitation matters because the global energy system was not built with enormous spare reserves, simply waiting to absorb a shock like this. That is something many people overlook. They hear about a temporary disruption and assume the market can easily push through it. But oil does not function like a digital product. You cannot simply pause a massive production chain and restart it the next morning. Once storage fills up, once export ports become congested, once refineries are disrupted, once production has to stop, that is not a perfectly smooth interruption. You are talking about operational damage that may take weeks to repair. Even after the original cause disappears, demand can return immediately. Supply cannot. That asymmetry is what makes this situation dangerous. Central banks now find themselves facing a very clear dilemma. If they continue to keep monetary policy tight for longer, they risk choking economic growth. But if they loosen too early, they will be seen as lacking discipline and allowing inflation to return. Whichever path they choose, the market will have to pay the price for that adjustment. And when you look carefully at what the largest investors in the world are doing, you begin to notice a signal that is worth thinking about. Gold has now moved past U.S. Treasury bonds to become the reserve asset that central banks prefer to accumulate. This is not a small shift in global financial thinking. For many decades, U.S. Treasury bonds were considered the bedrock of the monetary system, the default safe haven, the reserve asset of reserves. But right now, central banks across the world are showing their preference through very concrete actions. They do not talk very much. They do not debate on television. They buy gold. They buy it with real money. They store it in real vaults. They record it on real balance sheets. In the world of finance, quiet action often speaks louder than long speeches. Of course, the official language always sounds very polite. They call it reserve diversification, risk management, portfolio optimization. But if you look straight at the substance, it is a shift in belief, a layer of defense against the risk of currency debasement, a layer of insurance against geopolitical fragmentation, and also a layer of insurance against the possibility that the global financial system may be entering a period of greater instability. When the very people who operate the monetary system begin accumulating tangible assets, that is a signal a clear-headed observer should not ignore. What is interesting is that for many years, the ordinary investor has often been told that gold is outdated, that it produces no yield, that it is simply a relic of the past, something for people who are overly suspicious of the system. But while those words are spoken in public, the large institutions quietly watch and accumulate. Central banks do not buy gold out of nostalgia. They buy it because they understand that the economic order is always changing. And when those changes begin to surface, tangible assets often return to the center of the board. When gold begins to move, silver rarely stands still. Silver has always been the more volatile sibling. It carries a monetary role, but it is also an important industrial metal. Solar panels, electronics, medical applications, defense systems, electrical infrastructure, AI, hardware, the process of electrification, all of them require silver. That creates a very unusual structure. If gold is being driven by monetary distrust, while silver is being pulled by rising industrial demand, then when those two forces meet, the movement in silver can become very powerful. But that is also what makes it both attractive and dangerous. Silver is not something to approach with emotion. It requires attention and discipline. When precious metals enter a rising cycle, silver often climbs faster than gold. But when the market turns, it can also fall faster. That makes silver an interesting indicator of broader macro market psychology. Not everyone is suited for that level of volatility. But when viewed from a wider perspective, the combination of monetary pressure, geopolitical fragmentation, and industrial demand is beginning to form a new story. On one side, the monetary system is trying to defend itself against risk. On the other side, the real economy needs more metal to build energy, infrastructure, technology, and defense systems. When these two large trends appear at the same time during the same period, a metal that once seemed small, like silver, can sometimes become a very clear mirror, reflecting the deeper changes unfolding inside the global economic system. And that is the moment when patient observers begin to pay closer attention to what the market has quietly been saying. Now look at the response from the government itself, because this is often the moment when the real picture begins to reveal itself. Recent reports suggest that the United States Treasury, together with the broader policy apparatus, is considering measures that go far beyond the usual response, not simply releasing physical oil reserves. Some discussions have mentioned the possibility of direct intervention in the energy futures market. Think carefully about that. The very system that constantly preaches the efficiency of free markets and the natural mechanism of price discovery is willing to step onto the field when pricing begins to move in ways that are economically or politically inconvenient. That is not a small signal. It shows the level of seriousness in the risks they believe may be approaching. At the same time, there are also discussions about using emergency authorities, including provisions such as the Defense Production Act, to accelerate energy output and move past regulatory barriers that are slowing progress. When a government begins to mention tools like these, it is rarely the atmosphere of ordinary peacetime. It is the mindset of crisis management. Measures like these usually appear only when those operating the system believe the potential consequences are too large to leave in the hands of a slow-moving bureaucracy. Alongside that, a very pragmatic geopolitical adjustment is taking place. Countries that once opposed certain agreements during calmer times suddenly become more flexible. Temporary waivers, quiet exceptions. Compromises that once seemed difficult to imagine suddenly come back under consideration. When energy security is threatened, ideology often becomes far more flexible. Urgency always leaves a trace. And the market, much like a patient hunter in a deep forest, often catches that scent long before the wider crowd does. So what are the immediate risks ahead? First, oil prices can rise very quickly if transportation disruptions continue and insurance costs keep climbing. A three-digit oil scenario is not unrealistic if shipping choke points become even tighter. Second, inflation may return at the very moment many central banks believe they have finally brought it under control. Third, expectations for interest rate cuts may be repriced. Fourth, risk assets come under pressure. Fifth, consumers begin to feel the cost of living rising. Sixth, the outlook for global growth becomes more fragile. When these pieces come together, volatility in the stock market becomes almost unavoidable. But the important thing is not panic. The important thing is discipline. Do not sell everything simply because a frightening headline appears. Do not chase commodities after prices have already exploded. Do not assume every decline is automatically an opportunity. And certainly do not place large bets based on momentary emotion. Understanding information does not mean acting impulsively. In a tense environment, intelligent investing revolves around 4 core elements: preparation, position sizing, liquidity, and clarity of thought. What is even more important is the way you look back at your own portfolio. Which stocks are the most vulnerable if interest rates remain higher for longer than expected? Which businesses depend too heavily on cheap input costs? Whether fast-growing companies still deserve the same large allocation they once received? And when you say you are diversified, are you truly spreading risk or simply owning more stock tickers? Because hope is not a strategy. Emotion is not a strategy either. A real strategy is a clear framework. That is how large institutions think. Not because they possess some magical advantage, but because they operate through systems. They have rules. They respect risk. And they understand an old principle of the market that seasoned investors never forget. In serious investing, protecting capital always comes first. Opportunity only matters if you still have capital left to seize it. And that principle becomes even more important in moments like this. But if you step back for a moment and look at the wider picture, you begin to realize this is not only a story about oil. This is part of a larger structural shift unfolding inside the global economic system. De-dollarization is no longer a fringe argument. Central banks accumulating gold is not a coincidence. Strategic competition over commodities is not a coincidence. Supply chains becoming militarized is not a coincidence. And the fragmentation of the old global order is not a coincidence. These developments are all connected. Energy tension, reserve diversification, commodity nationalism, a renewed demand for tangible assets, and an increasingly visible level of policy intervention. When these forces appear together, the world begins to operate under a different logic. Less smooth, less trusting, and more unstable. When the environment changes, what once worked well for a long period may no longer work the same way. What was once considered a layer of safety can begin to look fragile. That is why understanding the macro picture before taking action matters so much. Precious metals are not simply a short-term trade on a chart. Energy is not merely a few lines of price movement on a screen. They are links in a larger shift in the structure of the economy. If you look at them only as isolated assets, you will miss the most important part of the story. But if you understand the structure behind them, you will begin to see how large pools of capital are starting to move. So let us summarize what truly matters. The disruption in the Strait of Hormuz matters because it threatens one of the largest energy arteries in the world. Time pressure matters because when storage capacity becomes limited and operational chains are forced to stop, a small disruption can quickly turn into a supply shock. Asia matters because much of this energy flow moves there, and when those economies compete for alternative supply, the entire global market feels it. Inflation matters because energy flows into nearly every cost inside the economy. Selling discipline also matters because risk management is the line that separates professional investors from the emotional behavior of the crowd. Gold matters because central banks are saying something very clear through their balance sheets. Silver matters because it sits directly at the intersection between monetary concern and industrial demand. And the response from governments matters as well, because when policymakers begin considering emergency tools, it signals that this is no longer an ordinary market fluctuation. But the most important lesson is actually very simple. Your portfolio does not care whether you feel optimistic or pessimistic. It responds to capital flows, to energy prices, to interest rates, to liquidity, to policy, and to expectations of return. That is the reality of markets. You do not need to fear that reality. You simply need to respect it. Markets always change. Cycles always turn. The long-term winners are rarely the ones who predict every move correctly. They are the ones who maintain discipline when the world becomes noisy. And sometimes the wisest decision an investor can make is not to act more, but to think more deeply before acting.